Hello and welcome to today's FinTech Finance Virtual Arena. Today I have Piers Marais joining me from Currencycloud. Piers, how are you doing this morning?
Very well, thank you, Doug. Thanks for having me.
Absolutely brilliant. And Piers, we're going to be talking all about embedded finance and how that's going to change payments and various other industries going on to the future. So Piers, for our viewers at home who might not be aware, can you give us a bit of background to yourself, your role and Currencycloud, please?
Sure. Yeah, my name is Piers. I'm product director for payments at Currencycloud. And if you've not heard of Currencycloud, we are a cloud native API-led cross-border payments platform. We power banks, fintechs, and FX brokers around the world to allow them and their customers to collect, convert, and pay out funds in 34 currencies to over 200 countries around the world. I've been at Currencycloud just coming up to 4 years. It's absolutely flown by. And as product director, I look after the overarching strategy and delivery for our payments teams for all of our outbound transactions for our clients and their end customers. Before that, I was a product manager for about 7 years within the global maritime industry. So I've shifted from one cross-border industry to another.
Well, that's why we've got you on here, because that expertise in various different verticals, and especially in that previous industry, so reliant on embedded finance now and that open API technology. So without further ado, I want to kind of get your opinion from your expertise. What do you think were the defining payment innovations in the last couple of years? And feel free to say if you think that was Currencycloud.
So I think there's probably three things, and perhaps not necessarily innovations individually in their own right, but have helped the entire industry to innovate. So the first would be the evolution of APIs, which has really allowed things like the concepts like embedded finance to come to exist over the last couple of years, especially. We have to think of APIs as the piping between different entities, between different, usually technology providers, that allows bits of data effectively to travel back and forth between one company and another. At Currencycloud, arguably, we've been at the forefront of providing financial services via API for the past sort of 8-9 years or so. And we like to think about APIs as Lego bricks, so kind of modular pieces that the consumers of those APIs can then fit together to build whatever construction they want to meet the needs and the wants of their customers. The second is around customer centricity. I'd say that over the past decade or so, there has been this fundamental shift in mindset from the corporate to the individual. It's no longer about what a business sells, but about what customer needs that business can satisfy. We've as an industry, I think, especially in financial services, we've shifted from selling products to solving problems. And as a product manager, I love that focus on the customer as being the source of what we need to think about. But I think more generally, the net beneficiary of this shift has been, the likes of you and me, the end consumers of apps or of websites across all sorts of different industries, but including financial services. And APIs, again, have been a key enabler for this. APIs have allowed businesses to, instead of each having to build similar versions of the same components again and again, those APIs have allowed businesses to pipe in those products and services from real kind of provider specialists, which in turn massively increases the time that any business then has to focus on their customer, to focus on solving or thinking about their needs, their challenges, their wants, and focus on finding solutions to satisfy these. And then the third is probably around the concept of speed, transaction speed, payment speed, and I would include Swift GPI into this. There's really been this proliferation of a need for speed, as I call it, which has followed and not led, but has followed the speed within the global digital economy. So the internet has enabled so many more things to happen in real time, from the basic, like finding some information in a Google search, through to something more complex, like buying something in real time and actually having it delivered in near real time. But I would argue that financial services are still, or have still been, playing catch up through that process. Look, in various countries around the world, there are domestic payment schemes that are real time. the UK's faster payments, for example. I think Japanese Zengin system was formed in the 1970s, and perhaps both of those have really led the way in terms of real-time transactions. But around the world, there are now about 70 countries with real-time domestic schemes either live or in development. And the consequence of this is that more and more use cases around the real-time transfer of funds, of transactions, can and have started to appear. I think if we then also think about from an international perspective, a cross-border perspective, that something like the Swift GPI initiative, especially over the last few years, I would say has been a game changer for the international payments community. For the first time, we are able to see how quickly some of those wire payments are traveling around the world. At Currencycloud, 40% of all of our transfers are crediting the beneficiary bank account in under 5 minutes, which to all intents and purposes is real time. And I think GPI, in addition to the pillar of speed, it has also increased this level of transparency, of visibility that the end consumers of this network have over their payments. And I think it's this combination of changes within country on domestic real-time rails, plus the overlay of GPI from a cross-border sense, that really now is meaning that the payments, at least within financial services, are starting to keep up with the global digital economy around us. Still some way to go, but we've come a lot further than we were.
I think that's a really interesting point, hearing how that increased visibility, that increased speed has been huge in every industry because of digitization. And it's finance is actually the one that's taken so long, but now is finally catching its stride. And another point is bringing up that visibility and how important it is. When we're talking about embedded finance, what comes to my mind is actually the fact that it's just a very almost invisible nature of making a payment, or at least dealing with your finances. But before we continue into that, I think to set the groundwork of the conversation, we need to have a discussion as to what exactly embedded finance means to you.
So the word that I actually always use to describe it is invisible. It is about that idea that there is some financial service. Again, the role that I'm in, we deal with account-to-account payments, or from my side as a product director. But this concept applies across financial services, and I think has been expanding over the past few years. It's about being able to make that financial service invisible within the scope or the realms of a completely separate product, usually actually from a non-financial service product or technology, for example. I think to give an example that I usually talk about, it's the Uber effect, right? Your goal as the consumer of the Uber service is to get from A to B, and the payment is a result of the real world action that has taken place, which is you needing to get to A to B and the driver needing to be paid, and the software provider also taking a cut of that. But it's that Uber effect where the payment as a result of the real world event that has happened becomes invisible. It becomes seamless within your customer journey, let's say, of getting from A to B. And I think that's one of the best use cases, perhaps one of the earlier use cases as well, of how a financial service, in this case a payment, has been embedded within a software company as part of some other, usually real world event that has taken place that requires a financial service, in this case a payment, to then occur.
Yeah, well, with that in mind, you've mentioned Uber, transport, and then obviously the transport as an industry being a beneficiary of embedded finance. But what are the main types of companies that actually currently adopt embedded account payments, and why? I assume the main alternative would really be for a lot of people just to build an in-house solution.
So I actually think about embedded finance being in its second wave right now. Again, Currencycloud has been delivering cross-border as a service via API for a good sort of 8-9 years now. And I think if we look back historically in that first wave, let's call it, embedded finance probably wasn't a well-known concept at that time. But that first wave was about embedding those transactions, making those types of services invisible, probably within other financial institutions. So it might be, let's say, a UK challenger bank spins up and wants to add an international payments offering within their application. They may well have come to Currencycloud and used our API suite to embed that additional offering within their application. And primarily that was so that they could get to market quickly, that they could increase their breadth of offering, they could perhaps increase market share and the revenue associated with it. And I think as we've come through the years, it's also about that ability to retain that customer within their ecosystem, within their app and websites. I think if we now come forward a few years to the second wave, it's really more about the non-financial services, now embedding those financial services within their systems. So it might be, for example, I don't know, an invoice software provider that lets you pay or be paid from within the app, or pull funds directly from different accounts to ease that friction of you as the end consumer, perhaps as an SME, for example, having to push or pull funds to and from accounts. Or more recently, perhaps the buy now, pay later examples are good ones as well, where the embedded finance is perhaps a microloan, something that actually starts to be embedded into the journey of purchasing something in some other ecosystem. So I think really for me, it's that separation or evolution from wave one to wave two, but perhaps the why behind embedded finance existing is still the same. It's about that speed to market, the breadth of offering, the customer retention, and perhaps acquisition as well. And you mentioned, the alternatives. I think for me, I see generally sort of three ways of doing this. The first is the DIY, build it yourself, as you mentioned, which is expensive, it's time consuming, it often needs huge amounts of expertise in the field of service that you're trying to embed. The second might be some kind of click-through revenue share model, which might be slightly faster to market, but is perhaps less profitable in the longer term. There's also sometimes a higher risk of losing your customers in where there is a click-through model with a provider that is offering similar services to yourself. And then the third, I would say, is the fully embedded solution, which is far faster to market than the DIY approach, far less costly, and usually gives you a much more beneficial longer term revenue model than the click-through model, without having to have that sort of specific expertise required within the organization.
Yeah, I completely. I mean, we've seen with even a lot of banks, they've found this, having to kind of diversify and offer all these different value-added solutions in the back end, not really suited to what they want to do. So, speaking of just embedding in that solution to get it right, I understand you use Validate. Could you explain how you use Validate and how this supports your idea of embedded payment offering?
Sure. So I'll kind of walk you through the flow, and we'll start off with the fact that Currencycloud currently offers payments in 34 different currencies to over 200 countries around the world. And generally we offer either the Swift wire transfers or connect into the schemes in country, so the domestic schemes in country, usually indirectly via a partner bank. And the challenge there is that we, as a cross-border payments via an API expert, don't want to be the people who have to understand the changes in routing rules, the changes in account number structures, routing number structures in every single country around the world. They're all different. They all change from time to time as banks or sometimes clearing systems update their rules and evolve. And we don't want to be the people who have to continually maintain that. We want to outsource that to the experts in that field. And the important thing for us is that Validate, in addition to having that expertise, in addition to having that breadth of coverage in pretty much every country that we support, also offers all of that via API. It would be absolutely no good, this solution being there, if it was in anything but API. But having the ability to, again, pipe that data between our different organizations via APIs allows that to embed that service, the validate service, within our ecosystem, and also upstream to all of our clients and the end customers. So in terms of the journey, an end customer of perhaps a neobank or a challenger bank is within their application, within the banking application. They've received some beneficiary details from the person or the company that they need to pay. And when they plug those details into the application, the various streams of APIs can then be called and then tell that end payer whether those details are valid or not. I think there are probably two objectives for this for the validation process for us. One is reducing the failure rate of payments after they've been created, and the second is to achieve a fully automated solution. We don't want any manual processes in that chain. So in terms of the failure rates, we can reduce that by making sure that the payment details that are entered up front are as valid as they can be at the point in time of being checked and when the payment is created, which reduces the downstream friction of a payer waiting for those funds to come back. If, for example, they've paid an account number at a routing number that is slightly incorrect. And the second, on the automated side, there are many perhaps incumbent banks who will invest a lot of manual time and energy into repairing payments. We, as a tech-first business, don't want that process to be there within our ecosystem. We want to have that fully automated solution, and us having the validate product embedded via API allows us to achieve that for our clients and ultimately the end customers, the end payers who are trying to move money from A to B.
Yeah, I mean, from that, it sounds like not only does it make everything seamless from your internal side of things, but also for your end users. For instance, if they were going to send some pounds from the UK over to the Rand in South Africa, it sounds like you've removed that friction for the customer. So, I mean, you've just touched on there that at the moment you don't really want to be handling that kind of in-house kind of headache of having to deal with that manually. So when should a company start working with regulators like the FCA, and when do they start crossing that line where they're actually regulated? And is there a grey area involved in that?
So I think from the regulation perspective, we should separate off a business that already exists within financial services versus one that sits completely outside of the financial service sector at the moment. If they operate currently within financial services, there is likely to be some sort of regulation already in place. They will likely know what they can and can't offer as a business, or at least they should know what they can and can't offer as a business, depending on that level of regulation that they have. For example, if with the UK regulator, if you are an EMI versus a credit institution, it allows you to or prevents you from being able to offer credit, for example, lending. But if we then look at non-financial services companies, this is where perhaps the line starts to be grayed more a little bit more. But I think from a non-financial service perspective, this is where embedded finance really starts to come into play. This is about a software company, a technology company that sits completely outside of financial services, is not regulated by, let's say, the FCA or an equivalent regulator in country, but wants to, because of some end customer need or pain point or challenge, wants to start offering some form of financial service. And I think this is where the likes of embedded finance providers, usually via API, like Currencycloud, really start to come into play, because there are, depending again on the type of client, there are those embedded services that can be provided without that business, that customer, needing to really understand all of the complexities of the specific regulation of the service that they're trying to provide. So they can, like we've done with the Validate product, start to outsource some of that headache, those pain points of things like regulation to the right kind of provider, who in turn will be regulated to outsource some of those services to a technology company, for example.
Oh, absolutely brilliant. Well, I mean, ultimately, we've kind of touched on a few of the kind of plus points for a lot of the end user, the customer. But I kind of want to add a future spin to this, because it sounds like we're just about to almost take off with this technology, and it's going to become, we've had the Uber moment, now finance is getting involved, and ultimately that means that every industry can effectively embed finance once the banks and the tech providers start getting used to it. So, if I could actually put this question to you, how do you see the end user actually going to be benefiting from embedded finance in the future? Especially when a lot of consumers might not even realize they are using embedded finance.
So I think if you put yourself, again, we're all using these apps and websites day to day in different forms. But I think one of the key benefits for the end customer is that improved trust in the brand that you perhaps already know and love, or at least have trusted enough to start using some of their services. You're not going to have that erosion of trust where you have things like click-throughs by signing up to one service in one app and then being forced to go through to another application website and having to effectively re-log in, recreate accounts to do something in some senses that's completely different, and in other senses is completely linked to the thing that you were trying to do in the first place in application number one. The second, I think, comes back to the user experience, the holistic user experience. I mentioned the customer centricity at the start, but we're going to continue to see that move towards apps and websites that solve your specific needs and pain points, because the builders, the creators of those apps can focus their time purely on you as the customer and trying to retain you as the customer, because they're not having to spend their efforts, their energies, and indeed their funds, their money on rebuilding things that already exist in other formats from other providers. And so I think there'll be this continued improvement of UI, UX, the user interface, the user experience, to make sure that you as the end customer really feel you get that warm, fuzzy feeling, in that app or in that website that you're using, that this is the brand that you can trust and the experience that's really kind of ticking all of those different boxes for you as the end customer. I think the other thing to note is also the benefits for things like the software companies, technology companies outside of financial services. We mentioned this already, but I think it's really important to talk about the improved customer retention through that better brand loyalty, things like the increased revenue streams as well, perhaps completely new revenue streams that were not available previously, that will really help in the global digital economy. New providers come up with new use cases to meet the needs of an evolving customer base.
Well, I, for one, as a consumer that uses a lot of these digital solutions to issues I hadn't once thought of, I can only imagine that in the next couple of years, there will be something that I could never have lived without a couple of years ago because of embedded finance. So I'm very, very excited. And Piers, thank you so much for your time. I think that's all we've got time for. And all our viewers as well, thank you. You can catch the rest of the series and much more over at www.fintechf.com. And of course, YouTube and LinkedIn. Well, I'll see you then. Goodbye.